Well, good afternoon. Happy Friday, February 18th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. So for most of the week, we've been watching the same thing we've been watching since the year began, and that's inflation. Inflation, if you've been watching this series every Friday, we know inflation is running about 350% of the Fed's target rate. The Fed wants inflation at 2%. We're running at roughly 7.5%. That's a 40-year high. We haven't seen a high like that since 1982. So, of course, that's problematic for mortgage interest rates. Everyone is anticipating that the Fed is going to raise the Fed funds rate at the March 15th, March 16th meeting, the policy announcement coming March 16th at 2 p.m. Eastern Time. Whether that's a half-point raise or a quarter-point raise, it's important to note that the Fed alters the Fed funds rate, not mortgage interest rates. The Fed funds rate is an overnight lending rate to banks and financial institutions. Mortgage interest rates are much more affected by investment or lack thereof in mortgage-backed securities, but all interest rates are being impacted by inflation being at a 40-year high. But a new piece of information has entered into our purview, especially over the last couple of days, and that is the developing drama out of the Russia-Ukraine situation. Now, Russia has amassed troops and munitions, artillery along the border. There's the threat of invasion, that Russia might invade the Ukraine. The Ukraine, the second largest country in Europe with 44 million people, a lot of natural resources. So this is a growing concern. And as this instability starts to develop in that region, and we're watching the United States response, it drives money out of stocks and into safe havens, and bonds are safe havens. And so we've actually seen a slight bit of improvement, unanticipated improvement, in mortgage-backed securities over the past couple of days. Let me show you what I'm talking about. So green days are good days, and you can see here the past 2 days, mortgage-backed securities finding their footing and bouncing back a little bit. That means slightly better pricing. These are not huge moves that we're seeing, but at least we've plateaued from the selling spree that we were on over the past 9 to 12 business days, and we've started to rebound a little bit. This is all around what's happening between Russia and the Ukraine, and the more unsettling it is in the short run is going to be good news for mortgage interest rates. Now, there's an index called the Volatility Indexes. Short term for it is the VIX. The Volatility Index, which looks forward about 30 days, and it tries to predict how much volatility will be in the market over the next 30 days. And the VIX is up substantially here today, up by 1.1. That's a 3.9% increase day over day. So we're starting to see the VIX rise in anticipation of a potential Russian invasion of the Ukraine, and then what the United States response will be to that. Certainly at least some economic sanctions. I'm sure some global political condemnation of any move like that. Whether the United States is actually going to put troops in the region or not, that still remains to be seen. Probably not, but certainly it's going to be an impact economically, and it's going to push, at least in the short term, push money out of stocks into bonds. So we might see some improved pricing, at least for a period of time. Now, as we move through spring, the narrative is still going to be about inflation, and our projections are that inflation is going to start to moderate as we move through spring into early summer. Still going to be well above what we anticipate what the Fed's target range is, which is 2%, but hopefully not at 40-year highs like we've seen here in December and in January. We can also take a look here. The National Association of Home Builders introduced this priced out estimate in 2022, and what they're saying essentially is that via a combination of home price increases and interest rates going up, there's a large percentage of Americans who are now, quote unquote, priced out of the market. And when you talk about this, you can think, well, hey, in the past year, we've seen average home price appreciation across the country at roughly 20%. That's 4 times the wage appreciation that we've seen. So we know that housing is getting more and more and more expensive. At the same time, what was keeping everybody in the affordability range were low interest rates. That narrative is gone. We're now seeing interest rates in the high 3s, low 4s for a lot of the conforming products. And what the National Association of Home Builders is publishing is to say that there are new estimates showing that 87.5 million households, roughly 69% of all U.S. households, are not able to afford a new median-priced home in 2022, meaning their incomes are insufficient to qualify for a mortgage under standard underwriting criteria. You can see here another headline from the Atlanta Journal-Constitution. Home prices are up 23.5% from a year ago. That's investors also fueling that surge. Atlanta being labeled the #1 spot for investors to come in and buy up investment properties. This according to Redfin, that data contained within the same article. So we're seeing a lot of people just get priced out of the market via a combination of home price appreciation with the very, very low inventory. Now inventory in town Atlanta below 1 month worth of supply. And of course, interest rate increases. If you take it on a percentage basis, mortgage interest rates have increased about 30% since the year began. That's a huge jump in a relatively short amount of time. So it'll be interesting to watch how this story develops, how the story between Russia and the Ukraine develops, and of course, everyone's got their eyes on inflation as we move through the next couple of weeks on into late spring. If I can be of any service to you, please don't hesitate to reach out. One product we're seeing a tremendous amount of traction on is our extended rate lock policy, where you can lock your interest rate all the way out to 360 days and get a free float down to market rates once you're within 30 days to closing. If I can be of any service to you, don't hesitate to reach out. 404-395-1102. Thanks.